So now let me start with you, because so much of this week, I think, was driven off of fixed income, particularly those Treasury rates. So what did we see this week, and why were there so many apparently violent moves up and down?
So, David, I think that we're going to continue to, it was a crazy week, but it's been several crazy weeks. I think until the market gets a sense of where the Fed is going to go and stop, we're going to keep getting these wild bouts of volatility. We've been expecting it for a while. In a sense, there was not that much of news in the Fed saying that they're close to being done. Well, of course they are. We already know that we're going to get up to 5, maybe 5.25, maybe a bit more, but quite early in the new year. It's pretty clear that they will be getting close to an end. We get a 75, maybe we get another 50, after which do we get another 50, another 25? I think the more interesting thing is what happens after that. Once the market feels that they know that the Fed is not going to pivot on a dime, I think we might get to a point where we stop seeing these wild back and forths, because these are truly massive moves in the Treasury market. And I would just note that every single data point is going to carry with it this level of gravity in terms of the moves that we see until we get to the stage that the market buys what the Fed is selling. And that is, they're going to raise and then they're going to keep it high for a while.
And Jurrien, where are we headed? Where is the Fed headed? Because I look at Bloomberg right now, the Fed futures rate looks like it's about 5.05. At one point this week, it was up close to 5.2 in terms of a terminal rate.
Yeah, so when you look at the SOFR curve, it peaks at around 5%. And you look at the implied terminal rate, it's around the same. The markets have been in a relentless mode of price discovery this year, right? And the glass has been half empty for the last 9 months, where every time we think maybe the markets are bottoming and the Fed's going to be close to being done, that moving target starts to move again in the wrong direction. But I do think we're getting to a more glass half full mode, and I think that's what the stock market is starting to signal here. That at this point the expectations for the Fed are so bad, meaning they're going to go so far that the possibility of a surprise may start to go more in our favor. So maybe the Fed doesn't have to go all the way to 5. Maybe only needs to go to 4.5. Financial conditions have tightened significantly, so maybe the Fed is closer to being done than we think. But as Sonal mentioned, that's only half the equation, right? Like, even if we know with clarity where the Fed's going to go and when, whether it's 4.5 or 5 or 5.5, we don't know what the path will look like after that in terms of reverting back to a neutral policy. And we don't even really know what neutral is. Is it 3%? Is it 3.5? But I think the Fed is pretty committed to getting inflation back towards its target of, let's say, 2.5%. And we're a long ways from that. And so I think the risk is not so much that the Fed overshoots or undershoots in the near term, but that it's going to take longer to get back to a neutral policy after it gets to that terminal point.
So, Jurrien, we were talking about this earlier today, and when I listen to what you're saying, I can't help but feel that for most in the market, there is this desperate desire to believe that we have the Fed that we've had for the last 17 years. And we can't, because the environment is so different than it has been. Well, maybe not last 17, because the last year and a half has certainly been this new world we're living in. But don't you think that a part of the volatility is markets which have become used to dramatic V-shaped recoveries in asset prices? So you miss the trade. So people keep jumping in, suddenly realize it's not going to happen yet, come out. And so you see these bouts of extreme volatility, largely because the market's been trained to expect that the Fed is going to step in when it gets too shaky.
Yeah, no, I agree. And since the financial crisis, the Fed has been able to not so much put the inflation mandate on the back burner, because I don't think it ever is, but it was able to spend most of its time dealing with
Yeah.
the full employment mandate, and then when financial conditions were tightening, they could, exercise the Fed put, as we call it, of course, and ease conditions and get the economy going. And inflation was never a clear and present danger, and of course now it is. And ironically, now the Fed is in the position where it needs to not only maybe tolerate a higher unemployment rate, but even have that at its goal in order to, to compensate for the overstimulation that clearly was happening a year or two ago in the economy with that combination of fiscal and monetary policy. So that Fed put is either gone or out the money, and that does, create a different response function in the markets. And so, and again, to the point I made earlier, knowing with clarity, which we don't know anyway, where the Fed's going to go and whether it's going to overshoot because it waited too long to start tightening policy in the first place. So now, instead of doing too little, too late, it's doing perhaps too much too late. But even then, we don't know how quickly the Fed will be able to go back to a neutral policy. And I do think that factors into valuation, because as you know, short rates, the Fed's terminal rate, real rates are important drivers, not only, of course, of the bond market, but of equity valuations as well, per the discounted cash flow. And calculating that present value of future cash flows does depend on where rates go, and how far they go up and how quickly they go back down is going to be an important factor.
Sonal, let me jump in here with a question to you. Is the Fed put ever truly gone? Because we thought maybe a BOE put was gone over the UK, but when things got really rocky in the gilt market, it had to come back in. What about what happened in the UK? And what does it tell us potentially here as well about the fragility of the markets and maybe the need for a central bank to step back in to give support?
So, I think that the UK, I'm not going to say, the UK, historically, we always use that phrase, right? Canary in a coal mine. However, I think in this particular case, the UK, what happened there is emblematic of what can go wrong. The immediate cause certainly was the mini budget, which was quite disastrous. The combination of spending and tax cuts clearly it was the wrong time for a budget like that. But we tend to forget it was 17 years again in the making. We've had a very extended period of extremely loose monetary policy, and that forced the UK, where you have a higher proportion of defined benefit pension plans. The UK is in a different position, let's put it that way, which is not to say that the US and other countries should not look at the UK and worry about the unknowns. We don't know where markets will break. And the reality is we are in a position where there is some possibility that something breaks. Will the Fed put? Has it gone away? I think the Fed might be left in this completely internally incoherent position that the Bank of England is in, where it's simultaneously buying gilts, but will continue to raise rates.
We're talking about
sense.
Sorry, go ahead.
Yeah, and exactly. The Fed put may be gone for the stock market, but I think it will be coming back for the bond market. And it's actions have consequences, right? And policy actions have consequences. And we only have to look to the Bank of Japan to see an example where they have the Bank of Japan owns half of the JGB market and has completely tamed the bond market. The annualized volatility of long JGBs is 3. In the US, the long treasuries have an annualized vol of about, I think, 12 or 13. And so if you're going to make fiscal decisions that have wide-ranging impact, and you're a central bank that has really dominated, the bond market, as of course the Fed has, as the Bank of England has, as the Bank of Japan has, you can't really leave that market. So I think that's how the Fed put is going to reappear, but just in a different market.
Well, so now one more here. Maybe the Bank of Japan has tamed the bond market. It sure hasn't tamed the FX market. And then on Friday, we got that news out of Nikkei, at least, that they are now intervening to support that yen, which had weakened so much. We've got the BOJ next week. Tell us about that. What does that mean? Is the yen broken?
So, what we're seeing is something we haven't seen in a very long period of time. We have the EU, Japan, and the US, all with dramatically different monetary policies. So I think about this, and when times were good, to misquote Tolstoy, all good markets, functioning markets look the same. And all of these markets, as they're breaking in different ways. And I think it's never been more apparent than what you see in Japan. The reality is the yen is moving in line with interest rate differentials with the US. You look at US 10-year yields and you look at where Japan's yen is, and it continues to move. Can the Bank of Japan can they control the yen? I have my doubts. They might take some of the air out of it, but ultimately this is a global system which is very interlinked, and the interest rate differential is simply too extreme right now to simply intervene to fix it. The other issue, of course, is Japan does not have the US's inflation issue. And speaking to the size of the bond market that is held, in the US, depending on what bonds you're looking at, the Fed owns between 25 and 33% of the bond market, right? So it's huge. It's a huge impact.